we have a very important line that we need to remember. And this line is somewhat confusing and honestly somewhat misleading because we've been hearing it for a long time and it hasn't seemingly come to fruition. But we have to remember, we, at least as of today's Fed meeting, on a median projection basis, haven't even finished the hiking cycle yet. So the line that's going to potentially become more important and seems to be very important for the Fed to conclude its work is the following. The full effects of the tightening are yet to be felt. Why is this line so important? Because after today, it became very clear that the Fed's goal is not just to get inflation down to 2%, but to also get a sustained period of below trend growth. Now, why would they want that, right? Don't we want a soft landing? Doesn't Jerome Powell want a soft landing? Yes, he wants a soft landing. But more important than what kind of landing we get is avoiding a 1970s style inflation rebound. Let's not forget, you can put a chart of the current inflation trends over a chart of the 1970s, and you will see in round one, inflation went up very quickly, came down very quickly, just like it is now on the headline number. However, just as it came down, and without the knowledge of history and the wisdom of history, in the 1970s, once we got to this point, and you hear this, lots of market commentary about this, so it's very understandable why people would think this way. You got a Federal Reserve that said, all right, job done, time to stop hiking, start cutting, start easing financial conditions. And then just a few years or a year or two after that, I don't remember the exact time frame, you see a second, even bigger rise in inflation. And I believe the Fed has very similar fears. They want to ensure that 1970s battle that had 3 subsequent massive waves of inflation that caused them to ultimately have to raise the federal funds rate to 21.5% and cause a massive recession is something they absolutely want to avoid. And they are willing to take a little bit more short-term pain to avoid a decade or so of difficult, volatile price instability that builds on itself, because 2% or 5% now is a bigger deal in nominal terms, particularly for retired people, than 5% in 2020. So what they want is to confirm a slowed and tightened economy to completely remove price pressures and the potential for a rebound in prices. Historically, and you've heard Bullard talk about this, companies have been hesitant to raise prices. There has been an actual fear of raising prices. Why would they be fearful of raising prices? Because they would fear that they would turn customers off. However, when people are looking at gas prices rise so much, there's so much talk about inflation and prices rising, the idea that you could just raise prices and get away with it very much gets washed up in all the noise. And it's no big deal. It's just another part of it. The Fed wants to get back to a period where when you raise prices, it's a big deal. It's a big calculation. It's not just something you're doing willy-nilly because everyone else is doing it because you have to, because all your costs are going up. They don't want that. They want to completely remove that. And they're not convinced that companies are actually going to hesitate around increasing prices until there is pressure on the companies themselves around prices. They want a notion of, bringing back sales, not wanting to raise prices. They need that environment. You've heard some Fed members talk about this idea. Bullard has, I know for a fact, talked about it on multiple occasions, that companies historically don't want to increase prices because it turns off customers. They lose customers. Now it's been something that just casually occurs. You just casually increase prices. So the Fed won't be content until that mentality resumes. One thing I want to address is the Fed is clear. This has been a common idea in consensus. We have not believed it. We have believed the Fed, and it should be very abundantly clear after today that they are not deviating from this path, but I definitely want to reiterate it. They are not moving the 2% inflation target. They're not making it 3%. They're going to keep at it until then. Jerome Powell did not hesitate today to talk about a higher neutral rate. Did not hesitate today to move interest rates higher despite not doing so with inflation forecasting. They're just getting hotter to cool the economy, to ensure that they can get to this 2% target because the economy has been stronger than expected. They're not hesitating to do this additional tightening. The economy is not weak. It's in a position that needs this. Even without the kind of inflation we've seen, the Fed would typically, in this kind of strong economic environment, hike interest rates. That's just what would happen. It's very classic. It's what occurs. When the economy is weak, the Fed cuts interest rates. When the economy is hot, the Fed hikes interest rates to prevent things from getting out of balance. They don't want an economy too hot because an economy too hot will cause inflation. They don't want an economy too cool because deflation, recession, obvious reasons. So they want to stimulate that and get stability. That's what they want to achieve. Obviously, we never have perfect stability, except when Donald Trump is president. Ultimately, the Fed wants inflation to come to their target and a period of below-trend growth to achieve their goals. And Powell said today, while inflation data was good, economic data was too hot. So, ultimately, we should expect the economy to get weaker. What this will mean for earnings and for companies is relatively unclear. There are some businesses that are definitely showing signs of weakness, particularly various companies throughout the retail space, unless they have some sort of secular recovery, like Abercrombie and Fitch. That seems to be coming back in a trend, but many others, Nike lowering forecasts, even Dollar General lowering forecasts, many other companies, Macy's lowering forecasts. There's some signs of weakness. So will that spread? I personally think so. I don't know what's going to happen. I'm kind of over trying to predict economic stuff like this. I'm going to stay towards specific things and Fed policy and politics and my areas of expertise. I've found out that expecting and planning for recessions is not easy. There's an element of randomness. So we must be humble about this element of randomness. But what we can see and is more certain is that the Fed is seeking to raise interest rates. So interest-sensitive areas of the economy will be hit. Interest-sensitive stocks should be hitting their earnings. And they also want a sustained period of below-trend growth. So consider what that could mean for the stocks you own and the higher interest rates and possible cascades throughout the economy. So that's today's video. And until next time, peace out.